When it comes to retirement and drawdown, it can be a minefield and confusing when it comes to working out how much income you should take from your drawdown pension without running out of money further down the line. It's common to hear about a safe withdrawal rate, which is the amount of income you plan on taking divided by the starting pension. 4% is a very common rule of thumb, which we've talked about before, whereas you'll often hear 3% is a more conservative figure, whilst others would say that you should be fine with a 5% withdrawal rate. In this video, we're going to look at an alternative approach that you may not have heard about before, which may allow you to take more income and at the same time potentially prevent you from running out of money further down the line. Using a static withdrawal rate such as the 4% isn't a panacea, as there are a number of issues with blindly relying on a fixed withdrawal rate. One of which is that using a static withdrawal rate like the 4% rule is that it doesn't take into account something called the sequence of returns risk, which is the idea that the timing of investment returns matter and make a huge difference, particularly when it comes to at which point you retire. Simply put, if the day before you retire there is a stock market crash and your portfolio is down 35% or more, this will have a much bigger impact on the sustainability of the pension fund compared to someone on the other side of the spectrum, perhaps, who retired and the stock market then went on a tear and the individual benefited from the stock market growth, which may have offset the withdrawal amounts. This has been the case for the past 10-15 years or so, COVID aside. Another criticism of a static withdrawal rate such as the 4% rule is that if investment returns are fantastic, your portfolio increases in value, it doesn't allow you to benefit from this and perhaps take an increased amount of income. In 2004, a financial planner, Jonathan Gayton, and a computer scientist, William Killinger, carried out some research on withdrawal rates. Their thesis was that traditional methods such as the 4% rule, or even a lower withdrawal rate, were in fact far too conservative, meaning retirees were potentially taking less income at the expense of perhaps not enjoying their retirement as much as possible and leaving behind a large sum of money. Their research centred around using a dynamic withdrawal rate, which sounds very fancy. This is really a word for saying a withdrawal strategy that adjusts in line with a portfolio's performance in both upwards and downwards markets, and adjusting the amount of income that you take accordingly. The TLDR was that by using a dynamic withdrawal rate, this may actually allow you to actually spend more money in retirement and at the same time avoid running out of money, hopefully. The research was deliberately centred around the period from 1973 through to 2004, which captured some of the severe market declines of the 70s brought on by the oil crisis and stagflation, in which the US stock market lost 45% of its value, and it also covered the dot-com crash in the turn of the millennium. Guyton calculated that the maximum initial safe withdrawal rate for this period was 5.8% for a portfolio made up of a 65% equities, which increased to a whopping 6.2% initial withdrawal rate for a portfolio made up of 80% equities. So that's all well and good, but what does this actually mean? What are the takeaways of this? Well, one of which is that retirees who are looking to squeeze as much income as sustainably possible from their investments or pensions, the Guardrails Approach, dynamic withdrawal rate, could be a good tool in your armoury. Essentially, in an upward trending market, the Guardrails Approach allows you to take more income, and conversely, in a downward trending market, it requires you to reduce the amount of income that you take. The potted version is that once your portfolio either increases or reduces by more than 20%, you increase or reduce the amount of income taken by 10%. In their research, in the final 15 years before the planned life expectancy, the requirement to reduce the amount of income that you take after that corresponding drop in the portfolio value was removed. This is because they found that reducing the income after this point had little to no effect on the success of not running out of money. Let's see an example. So Kevin's portfolio is 500k and he's taking a starting withdrawal rate of 4%, which we'll just use, and that equates to £20,000. 2 and a bit years later, his portfolio has risen to 700k after a resurgent bull market. Inflation during that time has been 6%, so using the Guardrails approach, how much more income can he now take from the portfolio to reflect that increased amount? So step 1, So his portfolio has risen by 40%. Step 2, we need to inflation adjust the starting income, so 20,000 multiplied by 6%, which equals £21,200. Step 3, we need to calculate the new withdrawal amount, which is 3.03%. Step 4, finally work out the difference in the withdrawal rate. As the new withdrawal rate is lower by more than 20%, he can increase his income by 10%. This means he can now take £23,320. Great, so that's in an upward market. How does it work in a downward market? So let's assume that Kevin retired a year ago, and when he comes to his 1-year retirement anniversary, a stock market crash has occurred and his portfolio is down by 35%. With the Guardrails approach, this means he has to take less income. As the new withdrawal rate is higher by more than 20%, he must decrease the adjusted inflation income down by 10%. This now gives us a lower amount of income of just over £19,000. One of the biggest advantages of the Guardrails approach is that, according to Morningstar's research, for an investor with a 50% equity and 50% bond allocation of all the safe withdrawal rate systems and withdrawal strategies, this allows you to take the highest amount of starting income out of all of the systems they tested. They found a starting withdrawal rate of 5.3% was possible over a 30-year retirement horizon. Morningstar's research reached the same conclusion as the original work, that is, for investors willing to allocate more to riskier assets, the starting safe withdrawal rate was even higher at 5.6% for investors willing to allocate 80% of their portfolio to stocks, and a whopping 6.3% withdrawal rate for an all-equity portfolio. Using a Guardrails approach can be a good idea for retirees who may have a smaller portfolio, or late to retirement planning, or just simply want to squeeze as much income from their pot as sustainably as possible. One issue with a static withdrawal rate such as the 4% rule is that it doesn't react to a changing world. If investment returns are significantly worse than in the past, inflation's higher, or there's just more volatility in financial markets, then a static withdrawal rate may no longer be appropriate. The argument with a dynamic withdrawal rate is that it adapts to a changing environment, be that in good years or bad years. Another advantage for some is that the Guardrails approach encourages you to take more money, even when investment returns are good and your portfolio increases in value. This could be useful for retirees who are a bit more naturally frugal, which may come at the expense of perhaps not enjoying their retirement.
Humbug.
The biggest disadvantage of this strategy, to my mind, is that it requires ongoing maintenance and is slightly more complex than a static withdrawal rate. It's not a set it and forget it withdrawal strategy such as a 4%, 5%, 3%, whatever you use. I must admit, in the example I did earlier in the first draft, whilst checking my numbers, I'd cocked the calculation up. As the Guardrails approach requires retirees to adjust their income dependent on market conditions, which could mean an increase, but also more importantly, a reduction in the amount of income that you take. Retirees who may have a core or essential expenditure that needs to be met, or they perhaps plan on taking more income in their early 60s before the state pension kicks in, for example, the requirement to drop the level of income may simply just be not possible. As the Guardrail approach stipulates that you can take more income from your portfolio after the investment performance is greater than 20%, it encourages you to spend more, and so this translates on average to a lower fund value at the end of the expected retirement date or mortality. For retirees who are not interested in leaving an inheritance, this isn't an issue. However, if you perhaps plan on leaving some of your remaining pension behind to your loved ones and take advantage of the tax advantages of this can be an important factor. It also isn't geared really to our UK rules and legislation and the inheritance tax position of UK defined contribution pensions, in which most pension schemes are outside your estate for the purposes of inheritance tax and will not be included as part of your estate when calculating if any inheritance tax is due. Therefore, the Guardrail approach may not be useful for retirees who are both looking to take advantage of the IHT position on UK defined contribution pensions, and also those who wish to leave something behind in their pensions to their loved ones. Hopefully you enjoyed the video, and if you are concerned about the stock market ruining your retirement plans, watch this video which looks at a couple of things you can do to prevent a stock market crash from ruining your retirement.